next week with the whole positions thing for the top performers. First of all, you can pick a whole new buy or short price. You don't have to stick with the one you've been given, and you can do completely new stop loss or take profit figures. You don't have to. It can be an entirely new set of values. In fact, I would even encourage you to probably go back and like refill the sheet. That would probably be the smartest option, but do what you will. If you want to change your positions at all, you don't have to.
And so you guys all got my email, right, about this previous email? Eric likes to preach, so hold on.
So, my name is Eric Jarst, as many of you here know, and as Travis duly noted in his email, this is going to be a primer over technical analysis, and because I tend to get a little passionate, it will be adapted maybe a little bit into a sermon. It's just who I am, and yeah, there's no getting around it. Well, thanks everybody. If any of you want to get a hold of me, you can do so at that email address. And yeah, so what exactly are we going to cover? We're going to go over what is technical analysis. We're going to cover the fact that, as many of you are well aware, the market is a chaotic system. The fundamental laws in which govern any market, or the laws that govern technical analysis. Then we'll look at briefly some indicators, some charts, some nomenclature. And I'm not too content with a lot of the nomenclature, some conclusions, and then any questions. Technical analysis is between an art and a science. You can look at mathematics, physics, biology, psychology, sociology. They all started out as a little willy, if you will. They didn't really have a very strong foundation. You can, if you want to go back to the Greek era, there was a point where folks were noticing certain things occurring. You know, you have right triangle, 1, 1, right angle 2. Technical analysis is sort of in that same sort of phase where folks are noticing certain things associated with any given market, any given security, and you don't really understand what's going on. And perhaps one of you in this room will actually help push technical analysis from that art form that it is now into the arena of science. So what do I think technical analysis actually is? It's really a behavioral analysis. And you're drawing certain conclusions about that system, what's going to happen. If you've ever been in a metropolis, New York or San Francisco, and if you've ever tried crossing a street, other various folks here, if this is a top-down view, is that you have these initial leads. They sort of start off like this, and the same is true of these folks. Start off like that, and then eventually envelopes start to form, and the masses start to follow in behind them. You start to notice these interesting effects, and how this pertains to the market is the fact that we're all human, we're all buying and selling, and we sort of exhibit the same or similar patterns of behavior. Because you're talking about stuff that is chaotic or bordering on chaotic, how is it possible that you can possibly determine where folks are going to travel or how certain securities are going to move? Maybe it's not so chaotic. I think 3 mathematicians from MIT, they actually published a paper where they incorporated some of the aspects of technical analysis to predict what would happen with particular securities. There are 2 fundamental laws which govern a market. The law of supply and demand. Of course, this is a generalization. The other fundamental law is that a lot of the things that you see occur are due to greed and fear. Again, because we're emotional creatures, because we're greedy, this is what helps drive prices up and helps make some sort of sense to what's going on. You know, when fundamentals are very strong and yet you're seeing a stock or a particular security go into the tank, it's probably because there's still fear associated with it. These are candlesticks, stuff because there's a lot of information in here developed by the Japanese. You have an open down here, you have a close up here, then you have a high, low, and then you have what's known as your shadows. Opens up here and closes down here anytime this is a filled area. A point and figure, I happen to like this. A lot of the squiggles that are associated with any given security. This helps display some overarching patterns, some of the things that tend to develop. Now, the important thing about a point and figure chart is it's one-dimensional. Time is independent of the price. It has no bearing. It just gives you a perspective. Every X symbolizes, or every X is a price movement upward. Once you're here at 24, you can only move to 25 if you actually hit it. If you're at 24.99, you're not allowed to post an X. The only way you can move over, but the only way you're going to move over is if it, now I'm saying we're right here right now, the security's at 24. The only way you're going to be able to move over into this column is if your price drops to $21. And then you would post these three zeros all at once. The same thing is true, so when the security starts to move back up, is if the security moves back up to $23, and then you would post these three X's. And it helps smooth out all this stuff up here. Okay, so the indicators. There's three types of indicators. Now, I'm not really satisfied with the nomenclature because, again, it's an art form. There's no real standardization. The first group are called momentum indicators. This particular indicator is the moving average convergence divergence. This is an exponential moving average, a 12-day and a 26-day. The 12-day is the faster moving average, the black curve, and the slower moving average is the 26-day. Another type of indicator or indicators are, again, I don't like this term, but they're called breadth. These are associated with volatility. These folks believe that you can make a decision based off of surges in volume, the volatility of a stock, its sentiment. There are some indicators out there that will give you an idea of what these people are doing. And again, I'm not too sure which indicators are associated with that. But another thing that's in line with that money's in smart hand is that in smart hands is that in any given situation where a particular security is overvalued, overbought, oversold, the market is going to penalize the greatest number of people. I've heard Ben talk about this before. He said he's looked at moving averages and the fact that the security is well above the moving average. You can consider that as a really overbought situation. You can make an argument that, well, because it's overbought, it's eventually going to do that. With maybe what you tend to see is that whenever a gap occurs in between price here and price here, is that the security tends to cover that gap. I don't know if this is so true here, but it is definitely true here, that it definitely covered that gap. That's what you tend to see. It's not clear why you tend to see that, but it tends to be true. I'm not sure about this one. I don't know if I really consider that a gap. Again, it gets back into that art form. There's something known as triple tops. Okay, this is what's known as a triple top. Anytime you see three X's like that, it tends to be true that whenever another X is placed here, it tends to be a breakout. It tends to be true that when you see these three zeros here, if it breaks that bottom, it tends to tank. If you allow your emotions to get in the way, and if you become blinded by what you see, and you look at a particular indicator, at a particular trend that is occurring, and you become just as greedy, you might ignore some things that are really occurring. You may ignore bad news, you may ignore all sorts of stuff.